The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I am Jeff Finn, CEO of RealNex. We still have many people joining, so we're going to give it just a minute and then we'll get started. But I want to thank you all for being with us and looking forward to starting the presentation. So just give us just a few seconds. Well, great. We do still have others joining, but they'll join silently, and we will get started. Many more to come. But once again, I am Jeff Finn, CEO of RealNex, and I am delighted today to be hosting the first in a series of RealNex webinars. This is the first of what will be a quarterly episode of CRE market updates, and then throughout the year we'll have some other topical and timely sessions for the commercial real estate industry, and we'll let you know about those as those stories evolve, and we are about to program them. Thank you all for joining. Very excited to have Dr. Jeff Fisher with us for this call. Dr. Fisher is the president of the Hoyt Institute and director of RealNex, and many other accolades, which I'll talk about in just a second as we formally introduce him. But today I just want to give you a little bit of a overview. We will have about 40 minutes of a presentation from Dr. Fisher, and then a formal Q&A at the end, which you can chime in using the chat feature on the right of the screen. But if you have something throughout the presentation you'd like to add, please do, and I will try to bring that into the conversation as Dr. Fisher goes along. So if there's something that's right on point with in the framework of his presentation you'd like to get some more color on, I'll be glad to try to capture that and bring it into the conversation. Otherwise, we'll pick it up at the end. But we are ready to get started. And again, this program and series is brought to you by RealNex. We are a most complete real estate technology solution for the commercial real estate industry. We have a full stack of technology, from CRM to help drive process efficiency, financial analytics for investment sales analysis and comparative lease, a full stack of tools to make presentations, from offering memorandums, proposals, BOVs, flyers, brochures, and websites, and the ability to accelerate sales and leasing processes. So if you're looking for technology, we'd love to have you as a client of ours. I know many of you are already, and we appreciate that. We also have a free list and search capability. So if you're looking for properties, please come to the RealNexMarketplace.com. And if you have properties that you're looking to sell or lease, we can give you some great exposure to the marketplace through the RealNex Marketplace. Come and check it out. It's free to list and search, and love to have you take advantage of that. So we are ready to get started with Dr. Fisher. If I was his mother, I would read the whole screen, and there's more that he gave me to get started with, but we're going to pass on that. I'll give you the highlights. Dr. Fisher is a partner in Pavonis Group, director of RealNex, and as I mentioned, president of the Hoyt Institute, a leading think tank for the real estate industry. He is professor emeritus from Indiana University, where he previously ran the real estate program, and the co-author of Real Estate Finance and Investments, one of the leading textbooks for real estate students in universities around the world. He is an expert and consultant and advisor to many in the industry. You can read the accolades and the awards that he's won. Don't need to get into all the details, but suffice it to say, an authority on commercial real estate trends, conditions, and particularly pricing. So today we're going to talk about pricing. Jeff, you've done a lot of research with NCRE, I know, over the years, and just recently have the year-end data out that you're working with, and we are anxious to hear your perspective as we move into this, what seems to be a new era, sort of a point that could be an inflection point of sorts, where we've been a 10-year run from the the Great Recession. It's been going strong, and now finally interest rates are starting to move up. Obviously, significant impact potential to the market. We really are anxious to hear how the interest rate environment, the development environment, and the economy is coming together to take us forward, and what your perspective for the future of real estate values and opportunities looks like. So I'll let you take it away, Dr. Fisher.
Okay, thanks, Jeff. Happy to be here, and if you have any questions, as Jeff said, let us know, and we'll try to answer them. If I can't answer them, I'll ask Jeff if he'll answer them. The other Jeff. So Jeff mentioned that one of the organizations that I work with is NACREIF, which is a heck of an acronym to try to pronounce, but that stands for the National Council of Real Estate Investment Fiduciaries. And this is from their website, where they say a leading provider of investment performance indices and transparent data for U.S. commercial properties. You might think that that's a pretty big claim, but actually it is one of the only organizations that has returns, because it's collecting data from its members every quarter on the value of the property every quarter, as well as the income, the expenses, capital expenditures, everything that's important for calculating the rate of return, as well as information on occupancy and different characteristics of the property, and of course the location of the property, and so their index is really a benchmark that institutional investors use, not only for comparing their own performance, but in many cases the incentive fees that are paid to the investment managers are based on them doing better than this index if they can. The types of members that we're talking about would be organizations like JP Morgan, Invesco, Morgan Stanley, CalPERS is a pension fund, CalSTRS, Deutsche Bank, Prudential, UBS, really all the large institutional investors. And they've been collecting data going back to 1978 as quarterly data. There's over 17,000 properties in the database, including sold properties. It's well over $500 billion in market value the current quarter. The main index is office, retail, industrial, and apartment, but data is also collected on property types like student housing, parking, seniors housing. There's been more and more interest in these other property types in recent years. The data contributing members, as I said, are the nation's largest investment managers. As I said, properties must be valued every quarter, as opposed to accounting, where you just put property on the books and it's depreciated. They actually do an appraisal on the properties every quarter, and that's used as a basis for these return measures. So it's a benchmark for performance measurement for the institutional investors. So with that background, and actually I put this in here, it just came out, as you see, February 12th, 2 days ago, or 3 days ago, to indicate how this index that we're going to be talking about showed how Chicago industrial sector has been booming. And I'm going to talk a lot more about how the industrial sector has been doing relative to the other property types, but you can see here they quote this index from the National Council of Real Estate Investment Fiduciaries, and it showed Chicago area industrial properties have had returns of around 12%, and that's an unleveraged rate of return for the past 5 years. So as an overview of the different trends that I'll be talking about, we've kind of labeled this steady as she goes, because returns have been very stable for about the past year, and we'll see historically what they've looked like here in a minute. But the returns for institutional investors did end the year on a slight uptick, which was nice. The volatility of the returns is at a historic low. In other words, the returns have just pretty much stayed at the same level for over a year now, in contrast to the stock market, where suddenly the volatility has come back, as most of you probably know, over this last week or so. The industrial properties remain by far the top performer. And when I say industrial, think warehouse and think Amazon. As we'll see, it's really warehouse in all the different sizes, from the larger warehouse to the smaller ones that are used for that so-called last mile delivery. Net fund flows, these are flows into and out of the real estate funds themselves that own the properties. Those are slightly negative, not hugely negative, but slightly negative. That's a little bit of a red flag. On the other hand, occupancy is at a 15-year high. And so looking at occupancy, the fundamentals are still pretty strong. Rent growth is still pretty good, although it's mixed by property type. Retail and apartment are struggling, probably no surprise to this group, and we'll elaborate on that as we go along. Industrial and office properties remain pretty strong. A little bit of surprise on office, but we'll get to that and elaborate on that as we go along. So these are a comparison of the returns across different asset classes, kind of a starting point to think about where real estate fits in. These are the quarterly returns as of the fourth quarter, so you need to multiply those by 4 if you want to think about it as annual rates of return. You can see that the far left, NPI stands for NCREIF Property Index, but think of that as unleveraged quarterly returns for private real estate. We're really talking about private equity investments. We're not talking about investments in real estate investment trusts. The performance of REITs is actually the second bar from the right, where you see NAREIT, National Association of Real Estate Investment Trusts, Equity REIT Index. Now REITs are leveraged, so that is higher than our NCREIF Property Index, which is unlevered, but the second bar from the left is the leveraged properties in the NCREIF Property Index, because institutional investors do use leverage on some of the properties, probably a little bit less leverage than REITs. And you see that return for the fourth quarter was pretty much the same as REITs for the fourth quarter. Of course, the S&P 500 did nicely the fourth quarter of 2017. A lot of that we lost. And then, starting to gain it back, the last couple of weeks. That's the problem with the stock market, is it does tend to be a lot more volatile. And in fact, the REIT index also tends to be more volatile, because when you take real estate and securitize it and it's traded along with stocks, it tends to act a lot like stocks as opposed to the underlying private equity. Farmland actually did fairly well last quarter. And then you also just see timberland, which has not done well. You may be surprised to see farmland and timberland on here. Actually, a lot of institutional investors own farmland and timberland. Of course, they don't do the farming. They lease the land to the farmers, but they own the large farms, vineyards, etc., as investments. The one that's labeled NFA Odyssey, you can say I put a note at the top there. Those are the returns for the funds that own the real estate. Maybe a little confusing if you've never seen this kind of thing before, but when I said the NCREIF Property Index on the far left, that's the performance of the properties themselves, whereas the fund index is an index of the performance of the funds that own the properties. The difference being the funds may have some leverage. The funds are like a business. They have cash balances. They pay the fund manager fees. They also do joint ventures, like you might have a joint venture between JP Morgan and Simon Property Group to do the development, or a hotel operator that's operating the hotel that's separate from the institutional investor that owns the hotel. Most of you see a Hyatt hotel or whatever, and that's owned typically by some institutional investor. Hyatt is the one that's doing the operation management of the hotel. This is over a 10-year basis. Again, just to put kind of things in perspective. NPI and REITs, especially the leveraged NPI, did pretty much the same, maybe slightly less than the REITs over the 10-year time period. Farmland did very well when you look at it over the last 10 years. Timberland still not well, and actually over the 10-year time period, the performance of the funds that owned the properties was a little bit less than the performance of the properties. Part of that, I think, is because the funds are using leverage, and 10 years takes us back and covers some of the financial crisis. And as you know, leverage can work both ways. It accelerates returns when the market is doing well, but hurts you when the market is doing poorly. So that kind of hurts some of the funds. And some of these funds are in more opportunistic types of investments and development projects. That's another difference in the fund returns, is it includes returns that they're getting on their development projects. I put this in just to put perspective on the whole history of the index and where commercial real estate has been since the first quarter of 1979. And you can see that this index really picks up the major moves in the market. You see the recession that we had in the early 90s, where investors were slow to write down their properties when we had the recession. And, so we had more of a U-shaped recovery. You see the effects of the tech bust in 9/11, and or the tech bust combined with 9/11, we should say, that resulted in a slight dip, and then the more recent great financial crisis where we really had a sharp drop. But then because things were written off pretty quickly, they came back nicely. Since then, you see where returns dropped and kind of went up again for a while, and then you see where we are now, where it was dropping pretty steadily from quarter to quarter, but nicely leveled off there at the end, which hopefully means that the drops in returns is going to stop. We'll see. Prices are still rising. If we were talking about this like we talk about the S&P 500 or the Dow Jones Industrial Average, we could actually say that we're still reaching new highs in the market. This is a graph again since 1978 that shows the price level, not the returns, but the level of prices and a trend line over that time period. And you can see we're not only above the peak that we had before the financial crisis, but we're quite a bit above that level at an all-time high, which prompted me to add this quote from our departing Fed chairman: "Commercial real estate prices are now quite high relative to rents," Yellen said. Now, is it a bubble or is it too high? And the Fed never likes to admit or say that you're in a bubble. They always, remember Greenspan used to always say, well, we won't know, we're in a bubble until it's over. But so she says, hard to tell, but it's a source of some concern that asset valuations are so high. So certainly asset valuations are at a high level. She says quite high relative to rents, which the way most of us would think about it is low cap rates. And we're going to look at a graph of cap rates as we move along. So this is what the returns have looked like since the first quarter of 2015. So as I was doing these webinars for NCREIF, each quarter it would be, oh, geez, returns have fallen again this quarter and fallen again this quarter. And so it was actually quite nice that when we entered into the second quarter of 2017, we were actually up from the first quarter, which was the first time it was up in a long time, as you can see. About the same in the third quarter, but then ended the year up again. So hopefully that means, again, the drop in returns has stopped for a while, and maybe part of that, whether we like the president or not, maybe the new tax law change, less regulation, the fact that all that could result in a higher GNP than we would have had otherwise is part of the reason that things have stabilized, and in fact the returns have gone up a little bit. And I'm going to come back and show you what's happening with the GNP and how that relates to returns here in a minute. But you notice the cross-border investment activity, this came from CBRE with their permission, borrowed that from one of their presentations. And you can see that the cross-border investment, and this also breaks it down by property type, but we're off the highs that we had in cross-border. That's money coming into the U.S. from other countries, which is still pretty strong from Asia, as you might expect, and from Canada and other sources. That activity is down a little bit, but still at a quite healthy level, as you can see, relative to where it had been historically. Of course, it peaked out sort of right at the beginning of 2015, so down from that high, but still at a quite respectable level. This shows the GNP growth and the rate of return for the NCREIF property index. And I think the point here is as the GDP goes, so does the returns on commercial real estate, at least in the long run. They're not perfectly correlated, but you can certainly see where when we had the recessions, the GDP went down, so went the returns on commercial real estate. And at the very end here, you can see the GDP has been going back up slowly. And I think that, again, may be one of the reasons that returns have stabilized, and we stopped that downward trend that we were seeing. So let's hope that we still have continued growth in the economy. This does the same thing with job growth instead of the GNP. We kept the returns as returns for all property types combined. Of course, job growth tends to impact office employment, or I should say office returns the most, but it really impacts the returns on everything to some extent. So kind of the same story as with the GNP. When job growth is strong, that tends to be good for rates of return. And we know that the job growth report was actually higher than expected. The most recent report, which did spook the stock market a little bit because that led to concerns that interest rates are going to go up. Of course, you know, the Fed's been talking about raising interest rates for a while now, so it shouldn't have really surprised anybody. And that's maybe why the stock market is now headed back up again. It's like, well, we knew there was going to be interest rate increases. Of course, the concern for real estate is going to be what that does to cap rates. We'll come back to that here in a minute. I did mention earlier that fund flows were slightly negative. So this is contributions and then distributions into the different funds. So by fund, again, let's say Prudential Real Estate Investors has a large open-end fund that people can go in and out of every quarter. It's billions and billions of dollars of property all over the U.S. and or TIAA that has retirement funds for many university professors. They have a real estate fund that you can put your money in and take your money out of. And so this is tracking the net flows. The green bars are the net flows into and out of these defined contribution plan funds, real estate funds. And you see that when they were negative historically, that tend to be periods of lower rates of return for real estate. So the fact that there's some negative flows over the past year, it hasn't gotten worse. It's kind of stayed at the same level, being just slightly negative. So that's something we're going to want to keep our eyes on to make sure there isn't a sudden desire of people to get out of these funds. But I think if returns have stabilized and kind of staying at the level that they are right now, although maybe not as high as they've been historically, they're certainly delivering a nice risk-adjusted rate of return for real estate that I think may even be helped by some of the inflation that's starting to come back. So moving on to cap rates, again, you see here the history since 1978 of the cap rates, and every time I look at this, it's just amazing that the cap rates have gotten down to the level they've gotten. Of course, higher cap rates mean lower values relative to the income, and we see again how the recessions in the past have resulted in cap rates going up as real estate was repriced. But then since the recovery started after the financial crisis, just every quarter down and down and down. It's like, how could they keep on going down? And yet they did, until this very last quarter where they're just slightly up again, or not again, but slightly up this last quarter. So the concern there is going to be what happens if interest rates start to go up. Personally, I think that's going to put some upward pressure on cap rates, but keep in mind that when interest rates go up, that may also mean that we're having inflation come back. And in fact, the inflation was, I think, 0.5% this last quarter, higher than people had expected. So that would be about a 6% rate. I don't know if it'll keep up at that level, but inflation has always been good for commercial real estate. It tends to put upward pressure on rents. You have expense pass-throughs. Maybe CPI adjustments on leases will come back. You've got pressure on construction costs. And so typically when inflation has been higher than expected, we ended up having higher returns on commercial real estate. And so I think that's going to help to offset the pressure from rising interest rates. We won't know until it really happens, but I'm not quite as concerned about interest rates going up. And another reason for that, we'll see in a minute, is that we still have a pretty healthy spread between cap rates and treasuries. Acquisition volume, though, to jump to that for a second, is still at a pretty nice level. So people are still buying properties, not too far off of even the highs that it was a couple of years ago. So acquisition still going strong. Of course, you can see industrial is a big part of that. Okay, and then I alluded to the spread between cap rates and in this case we have the triple Bs. So you can see that the spread between cap rates and treasuries and triple Bs has remained pretty level, that cap rate spread over the past really almost 5 years. And so a lot of people will argue that because we do have that cushion there, there could be some upward movement in interest rates that doesn't necessarily push cap rates up right away, that it'll just more result in a narrowing of that spread. These are the cap rates by property type. So if we look at, let's say where we are here in the current quarter, you see industrial, and this kind of surprises me actually, that the industrial, and again, think warehouse, cap rates are the highest, yet that's been the best performing asset in terms of the rates of return and where the demand has been certainly over the last year. And that kind of leads me to believe, and I warn you, your crystal ball is as good as mine in terms of what's really going to happen in the future, but this would tend to let me think that there's still some ways to go for warehouse space that would tend to drive those cap rates down to be more in line with the other cap rates, because as long as we're going to continue to get growth in that space and it's not considered riskier, of course, so some of the risk would be new supply coming online, but that's true of all the property types. Anyway, those cap rates tend to, or at least right now, are the highest. The apartment are the lowest. Apartment have just about always been the lowest. An exception to that actually occurred during 2016, where you see the office cap rates actually dip below the apartment, what really surprised a lot of people. You normally don't expect to see office cap rates to drop at that low a level. People love office, at least the institutional investors love to invest in office space. And then this shows discount rates. In this case, it's the discount rate that's going into the discounted cash flow analysis being done by the appraisers when they're valuing the property for the institutional investors, whether they're putting it into a program like Argus. We actually at RealNex have our own discounted cash flow program in Market Edge that, at least if it's not a real complex lease structure, we'll give you the same answer. And so what this is showing is each quarter what discount rate was being assumed as the rate of return that investors should get going forward on the different property types. And again, you see industrial pretty high, office actually slightly higher, but office has always been one of the riskier of the property types, which again makes me wonder why the cap rate for office drops so low when the discount rate is still relatively high. That can only be explained by expecting a lot of growth in office rents and values. And actually I have more to say about that when we get to one of the later slides, but again, you see the discount rate for industrial higher than I would expect it to be, because it doesn't seem to me that an industrial space is necessarily more risky than it would be for retail or apartments. But that's just my opinion. Although it's supported by some facts without getting too nerdy, and this is actually something that's done by NCREIF as a tool on their website for the institutional investors, so it's not something that some crazy academic like me put together. It actually shows historically over the past 5 years where the return has been for the different property types and some of the major CBSAs relative to the standard deviation of those returns, which is one way that we look at risk, just how much volatility is there in the returns. And you see industrial has the highest return but the lowest risk. So I guess it's no surprise that there's been such demand for industrial. If it's the lowest return and the highest risk, something's got to give, right? It's like it's going to move back towards that line that we have going up there, that goes through DC, because DC has always been sort of a stable, lower risk, lower return market supported by the government, which is not going to go away. The line goes through the US, which is the whole market, and it goes through apartment in this case. So apartment looks to be priced about where it should be right now. San Francisco, you can see, is like a higher risk but higher return market, although you could question whether it's getting the return it should get relative to the volatility we have, maybe because of the volatility in the tech space. So don't want to read too much into this, but it is one of the things that institutional investors will look at just to get a feel for where do we want to put our money? Do we want to, have less money in San Francisco right now, maybe a little bit more money in industrial, maybe cut back a little bit on New York and, so forth. So that's the way you would kind of interpret this, along with, of course, doing, a lot of fundamental analysis and looking at brokerage reports and other sources of information to decide what markets you want to over or under allocate capital to. These are returns by either over $100 million properties or under $100 million properties. There are properties up to $1 billion in market value for a single property in this particular database. If we looked at this historically, right after the financial crisis, the money was going into those properties that are over $100 million and in the largest CBSAs. But then as price levels got up in those markets, and investors searched for higher rates of return in other markets, that capital started to move. It moved into the under $100 million markets and the smaller CBSAs. So you see here the rate of return in the under $100 million markets is actually quite a bit higher than it was in the greater than $100 million markets. And then here you see the top 10 markets versus the other markets. You see it's kind of the same story that I was just telling. The top 10 markets, which did the best coming right out of the financial crisis, now are at 1.63%, again, quarterly. So you'd have to multiply that by 4 to get an annual return, and it's unleveraged, so leverage would take your return higher. Then the other markets are 2%. So again, capital flowing to those secondary markets in search of higher rates of return. In fact, you can see what the top 10 markets are. In this case, top 10 by where the capital is, like $66 billion of property in New York City, $42 billion in Los Angeles, and so forth. So it's where the capital is, and then we're looking at the returns on those markets where the most, at least institutional capital, tends to be. And you can see NPI is like the average of all markets in the country. So you see to the left of that, Seattle, the best performing this last quarter, Denver, DC, Dallas. But then the markets that didn't perform quite as well, Chicago, Los Angeles, New York City, Houston, and Boston. But that does change over time. Some of the reason that some of the markets are not performing quite as well this quarter is because those are ones that performed quite well when we first came out of the financial crisis. This is another way to look at it in terms of which markets tended to move the entire index, the entire national index, the most by CBSA and property type, and it was picking the ones that tended to move it the most, either up or down. So you can see that let's look at industrial. Every one that moved it up. So Los Angeles, Inland Empire, Chicago, New York, Tacoma, those all put upward pressure on the entire index, and really you could almost say saved the index in terms of keeping it keeping those returns up, as we saw in the earlier graphs, because all the major markets were moving retail down. You see New York moved it down, Houston moved it down, Portland, Chicago, Dallas, and 4 out of 5 of the apartment and office markets tended to put downward pressure on the index. Again, these are the ones that tended to move it the most. There's other markets that certainly had higher returns than average. Actually, this graph, when a property type and a CBSA moves the index one way or the other, it's a combination of what the return was and the amount of capital that's in that particular CBSA. This just focuses in on the returns this last quarter, fourth quarter 2017, for each of the major property types: apartment, hotel, industrial, office, and retail. And so, as I've been saying, look at those returns for industrial properties. Industrial properties by far outperformed everything else, 3.3%. Multiply that by 4, you're well over 12%, almost a 14% rate of return on an annualized basis before even any leverage. So put leverage on that at today's interest rates, below 4% probably, and you can see what that would do to the leverage rate of return. And then this breaks it out into subcategories. So you can see the high-rise apartments, not quite as high return, low, followed by low-rise, and the highest return was for your garden apartments. Tend to be most demand right now for the garden apartments, and haven't had quite as much building of the garden apartments. With warehouse, so a little surprising that actually all sizes did well. Didn't matter whether it was the local, the size built more for the local market or the really large properties. The bulk warehouse, they all perform pretty well. And then looking at it by CBD, suburban greater than 100 million, or suburban less than 100 million, you see the middle one there, suburban greater than 100 million had the highest return. And then finally, the retail by property type, the neighborhood centers, kind of surprising maybe, did the best relative to the super regional. Of course, we've had a lot of store closings, impacting those super regional malls. And then other types of retail outside of your malls and neighborhood centers. This is the net operating income growth. So you can see that the NOI growth, I think, is really still pretty strong. It's not at the level it was fourth quarter of 2014, but if we could continue to have 5.2% net operating income growth, I think that would be pretty good. And then the net operating income growth by property type, you can see that retail is the lowest. It did come up a little bit this last quarter, but with all those store closings and pressure on retail outside of the internet retail, I guess not surprising that retail growth is not quite as high. Apartment, that had the highest growth coming out of the financial crisis. People not being able to get mortgages or losing their homes. So that led to strong apartment demand, but then we've had a lot of construction of apartments. So that income growth has dropped down. You can see how office has really jumped up. In fact, the highest right now in growth. And talking to the different institutional investors, what I'm hearing is a lot of that is leases that were written 5 years ago that are now rolling over at much higher rates than they were able to write the leases at 5 years ago. So that's accounting for a lot of that growth. And then the industrial growth second to office. I think we all know at this point what's going on with industrial space and the demand that we have from the online retailers. And then rental growth, not quite as strong as the NOI growth. This is not market rents. You get market rents from a lot of other sources. This is the actual rent being collected. It's reported from the accounting systems. So considering lease rollovers and existing leases, and some of those written at rates that were a couple years ago, all that would come into play in what's actually collected. Still 3.5% is a decent level of rent growth. As long as those rent growth numbers stay, I would say above 3%, I think that's still pretty healthy. And again, could help to keep those cap rates down that might otherwise tend to have some upward pressure. Cap rates are really a result of what kind of rate of return investors want, but then lowered by the expected growth in the future income and value of the properties, which means you're willing to pay a little bit lower cap rate today to get some growth in the future. So hopefully those growth numbers will remain pretty strong for each of the property types. And this does break it out by property type, where we've got industrial growth on the top. I keep talking about industrial, but that's just the way it is. Not that I'm promoting it, but this is the actual performance on all these properties. Again, over $500 billion of properties all over the U.S. that we're looking at here that you'd like to think are managed by some of the top professional managers. And of course, they hire property managers that probably some of the companies that you guys work for are doing the actual property management, hired by Prudential and others. So the industrial properties have the highest rental growth rate, followed by office, and then apartment and retail. And then this is the market rent growth that's being projected at each of these points in time. So we're jumping again to what would go into a discounted cash flow analysis, where in your Argus run or your RealNex market edge analysis, you're putting in a growth rate that you expect to happen to market rents for each of these property types. I think it's interesting here that it started off that there was much higher market rent growth expected for office, with retail being the lowest. Retail has pretty much stayed the same over the whole time period, but office has come down. All the other ones have come down, and so right now it's like, well, a little bit over 3% for all of them. We're really not a lot of differentiation in the market right now on the expected growth on each of these property types, which is a little different from what we're actually seeing in the growth from those previous charts that we looked at. So you'd think the appraisers would maybe see a little bit difference than we're seeing here, and the kind of growth expectations that they're putting in the DCF models. But of course, what I was showing you before is what's actually happened, and these are what's projected over the next 5 to 10 years in a DCF analysis. And then these are the occupancy trends. So you see occupancy since the fourth quarter of 2013, 90, 91, 92, 93, 93.6. Occupancy can't go much higher because you're always going to have some what they call frictional vacancy in the market. Companies that have to move for one reason or the other, or owners just keeping some space off the market, or space being renovated. So we're pretty much at about the highest level occupancy that you might expect. Hopefully it'll stay at that level. This shows the long-term occupancy trends, and so you can see how we're at a high that we haven't seen since, if we go back to around year 2000 to get the level of occupancy that we're seeing right now in all the different property types combined. Of course, that's driven a lot by industrial. Here you see it across the different property types. Apartments went up a lot right after the financial crisis, and then that occupancy is just kind of bounced around. Slight downward trend as we've had new construction coming online. Office occupancy has been going up. Not much new office built on a national basis. Retail occupancy actually doing pretty well relative to kind of what we're seeing in the growth rates for rents and so forth. So can't say the occupancy is really bad for retail. Industrial, of course, the one that's had the most increases in recent years. These are capital expenditures as a share of the net operating income for the different property types. A lot of people don't realize just how much CapEx has to go into properties, and it's like the below the line, numbers that go into a DCF type of analysis, and you see that office over 45% of the NOI is consumed by capital expenditures, whether it's TIs, leasing commissions, remodeling, or even expansion of space. Industrial really jumped up, you can see, and when we drill down to that I think the next slide, we'll see that a lot of that is because of remodeling and adding on to space, which no surprise, if with a strong demand for industrial, you want to be competitive and make sure your space is as modern as possible. So pretty big jump up there, in at least as a percentage of net operating income into the CapEx going into the industrial properties. And you see that here where it breaks out the CapEx into the categories of leasing commissions, TIs, and then the building improvements. So the building improvements for industrial certainly shot up. Apartment even came up a little bit over the last couple of quarters. Office has been kind of steadily rising. And then retail, I think some attempts there to keep your space competitive. And in some cases, figure out what to do with that space that was vacated by one of the retailers that went out of business. So you see the building improvements that are going into the different property types. I just threw this in for fun before we wrap things up. In terms of the slide presentation, this just came out a couple of days ago. We hear a lot about Bitcoins and talk about using the technology behind the Bitcoins to actually create asset-backed coins. And so it says here, El Segundo-based startup Aperture Real Estate Ventures plans to launch a real estate-backed cryptocurrency by the end of February in an already speculative market. Their property coin lets investors in on home fix and flip models. So a lot of talk about using that blockchain technology. I hear more about it for as a way to keep track of titles, and but there's a lot of talk right now about having some asset-backed cryptocurrency. So maybe that's something we'll explore at RealNex and see if you want to have some of our listings be available to buy with Bitcoins or something. So let's summarize some of the things we've talked about and then see if there's any pressing questions. Jeff hasn't interrupted me with any. Hopefully I would have been able to hear him if he did have some questions. So fundamentals should support solid, although below average real estate returns. You've seen that the returns are below the averages that we had, but certainly at a, I would like to think a sustainable level, a reasonable return that would give us a higher return that I'd expect for bonds over the next year or so, and probably a little bit lower return than you'd expect with stocks. But that's where real estate should be in terms of risk and return, is kind of between stocks and bonds. Cap rate spreads are near long-term averages, so hopefully that'll insulate the values from rising cap rates. I mean, rising interest rates to push up cap rates. Rental income and NOI growth are above average overall, although retail and apartment are slowing, as we've seen. Overall occupancy is a historic high, but driven largely by industrial space, although we didn't see any real dips in occupancy for any of the other property types. And then institutional investors do expect returns to continue at the current level. When we did a similar webinar for NACREIF about 2 weeks ago and surveyed them during the webinar, they all thought that if anything, markets wouldn't peak until later in 2018, maybe even the year after that. So, but nothing is guaranteed. We all know that there can be sudden things that happen, those black swans that nobody expected, that cause all our forecasts to be way off what we expected. But I guess maybe that's what makes it fun, right, Jeff?
That's perfect. Yeah, that does keep it interesting and keeps all of those on the phone in business because of their ability to understand the market, the nuances, and the changes and the opportunities presented. So there are a bunch of questions, Jeff. I didn't want to interrupt you because you were there's just so much valuable information to get through, and one of the questions actually pertained to that, questioning whether the slides could be made available. And
we
wanted to make
can
sure
do
that we can do that. So we will make them available. We also recorded the session, so there'll be a recording of the session for those that weren't able to join, or some of your colleagues that you think might want to take a look. We will send a note out with the availability of that shortly. A couple of other questions that came up, and then a couple of thoughts as you were talking that I had, and just wanted to get your perspective on. With all of the gyrations in this, not just the stock market, but bond and real estate as an asset class, what have you seen as the trend in asset allocation theory as far as real estate? Are the funds that you've observed at that mark currently? Are they over or under?
They aren't. If you put real estate along with stocks and bonds into models that tell you what's the optimal allocation that you should have, usually you end up with somewhere around 10% real estate, and pension funds right now, which is a large source of, as you know, the capital for institutional investment managers. On average, the pension funds are only about 5%, and there's a lot of pension funds that still don't have real estate. And I think real estate has become much more recognized as an asset class that investors should have capital in. It doesn't have the kind of volatility that you have in the stock market, and private real estate doesn't have the same volatility as you have with REITs. REIT prices just behave differently than private real estate. So I think there's more and more interest in investing in real estate as an asset class, and more ways of investing in real estate, right? Every time Blackstone wants to raise capital for real estate, the money just comes, doesn't it?
They don't seem to have a problem raising the fund, that's for sure. So a couple of observations, and
you said BlackRock. There's BlackRock and Blackstone, but both of them, are very successful in raising capital.
One of the observations was regarding the comment about industrial caps being high at 5%. Keep in mind that there's already been a tremendous rent increase in the industrial space. Rents moving from 5 to 9 in some markets, and cap rates are reflecting those value changes in rents already.
Yeah, so the cap rate, as we talked about, is really impacted by two main things: the rate of return that you want, the discount rate, and then your expected growth in rents and values. In fact, mathematically, it's almost like you can take the discount rate minus the growth rate, and that gives you your cap rate. So when I look at the cap rate being higher than the others, I say, well, should the discount rate be higher? And it is in terms of what appraisers are putting in their DCF models, but I'm struggling, and you can help me on this one. Why would industrial space necessarily be riskier? I realize they're relatively easy to build, and there's maybe some concerns about how technology may change that. But yeah, if you have a long-term lease with Amazon, it's not clear to me that that they're a whole lot riskier, especially compared to, let's say, retail, where you're really dependent on how successful those tenants are going to be. So it just looks to me like there's room to grow in returns for industrial. And what we tend to see, especially with institutional investors, is it's like a herd mentality. Think about what happened with apartments right after the financial crisis. It was almost, of course, it's easy to look back, but it's like, oh, apartments should do well. People are losing their homes and can't qualify for mortgages. How long did that last, Jeff? Like it went on and on.
Yeah, and it took so
right?
long because there was no capital available for developments. You had that compounded coming out of the recession. You had a steady supply. No one could raise the capital, the debt anyway, to build for a number of years. And now that's starting to hit, and that's what ends that cycle.
Yeah,
it seems like
maybe what's going on. Yeah. And with industrial, I think it may also be that people are all of a sudden realizing, hey, industrial didn't used to have a lot of respect, right? It's not something you put on the brochure of, that you send to your investors, right? You want to put that nice, pretty office building.
Yeah. And it doesn't have a long lead time and the same boom and bust as a major office tower coming online.
And I should mention, when we surveyed the investors that were at the NACREIF webinar, they all picked industrial as the top performing property type for this whole year, 2018, going forward.
You got a bunch more questions in limited amount of time, so let's move on. I think I know the answer, but I'll send it your way. The NACREIF data is more heavily weighted to primary and larger markets versus secondary or tertiary markets.
Definitely, although you'd be surprised that there are investments in the tertiary markets, especially the secondary markets, but to some extent the tertiary markets and even the smaller property types. But certainly it's weighted towards the larger properties. But all boats tend to rise and fall with the tide. So your local market and everybody on this call knows their market a whole lot better than I do. So you have to ask yourself, is it following the national trends or even the trends for the different CBSAs I showed? But ultimately, though, I think they all tend to be pretty highly correlated.
Yeah, I think the institutions want to be in the most liquid markets to start, but when they can't get the yield there, they'll start to move further.
That's exactly right, and that's why we saw that you saw the higher returns in the secondary markets that I showed, and the under $100 million, and that's the capital is moving to these secondary markets, and the capital chases return.
It's just taken a long time. The next question's on: do you have any source, or is there any tracking at the sub-sector level, particularly in the medical office?
Actually, NACREIF is working on indices in those subsectors. You'd have to be a member to be able to get access to the data, and you can be a member as a professional member. A lot of appraisers are members and academics of NACREIF. So you don't have to be one of the large investment managers to be a member and get the data and be able to get a lot of the different reports. But they're working on indices for like seniors housing and student housing and parking, Parking's an interesting one right now with driverless cars. I'm not sure I'd be investing in parking, but that's a story for another day.
That might be a good topic for a discussion. Some of those technology trends and how they'll impact the investment thesis, which is one of the next questions. Why are garden-style apartments in such high demand? And it might be that they're in high demand from the funds because they're in high demand from the people, and also because, again, the liquidity.
Yeah, I think because of the liquidity, there hasn't been a lot of them built on a national basis, and I think a lot of the younger people are moving into the garden apartments.
Finally, getting out of the basement. Let's see, the great webinar. Well, we appreciate that. No question, just a comment. Thank you. We will look forward to doing more.
It.
You see institutional investors are running away from retail. Any flight of capital there?
There's a lot of concern about retail right now, but they're not going to run away from it. So I think it's still going to be allocated to the portfolio. So it's not like they're running away from retail. It's just that they're cutting back on their allocations to retail and adding more allocations to industrial right now.
And some of them may have invested in retail, and it ends up being something else. So you've got
that's true too. A lot of retail is turned into industrial, right? Or what happens if it's a Whole Foods and it was retail and it's bought by Amazon and they're also using as to store the stuff.
Center. Food distribution.
Yeah, so I'm not even sure how you classify it anymore.
Let's just have a couple minutes. I appreciate everyone. We still have a great audience out there, so we will try to wrap up promptly by 2, but a couple more questions before we do wrap up. Any data on new or planned projects?
No, NCREIF doesn't have any of that data.
Any observations, or you just leave that one?
Yeah, can't really answer that one.
What really makes the difference when appraising a mixed-use property versus residential? Same type, for example, 6-family residential versus mixed-use.
Yeah, we've had some. We do have some mixed-use properties in the NCREIF database, and actually, Bill Wheaton, who many of you know, teamed up with one of the academics, Rick Pizer, and they did some analysis of that, and they were finding that I guess lenders for some reason are more reluctant to loan on mixed use properties. You'd think that they would consider it sort of more diversified, but it's like we're not quite sure. We understand mixed use as well as loaning just on an office building or just on apartment, and they found the performance wasn't quite as well, at least of those properties in the NCREIF database. But there's certainly a lot of interest in mixed use properties these days.
Excellent. Well, I think, Jeff, if you could move to the next slide, we can wrap up. I think we've got all the questions covered, and certainly give you another minute if anyone's got a pressing thought. But we want to thank you all for joining us. This has been a great start. Thank you, Jeff, for your insights and perspective. A great start to this webinar series. We'll be reaching out to the audience with the next one in a few months when the first quarter of 2018's data is available. We can put it back into a presentable form for you. And again, as other interesting topical thoughts come to the commercial real estate space, particularly as technology trends are driving change, we'll be presenting some insightful webinars to help keep the audience informed on our perspective there. So to learn more about RealNex, please join us at realnex.com. And again, to seek or find your next investment, realnexmarketplace.com. Really dynamic marketplace to showcase both property for sale and lease. So come look for property there. And if you've got anything that you'd like to present to the marketplace, free to list and search. So please join us in the marketplace. So thanks again for joining us. And Jeff, thank you for the great presentation.
You're welcome.